Welcome to Market View with Ike Iosa and friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Good evening. Mike Iosa, your host for my guest. My very good friend, Mr. Mark Arbeter. Hi, Mark. How are you?
Great, Ike. How are you?
I'm doing well. And Mark, for 17 trading days from May 24th until June 15th, the S&P rallied 8.7%. In terms of magnitude versus time, the 8.7% advance in just 17 days was 3 standard deviations above the norm. So reversion to the mean is in order. And therefore, the pullback of the last 7 trading days should not be surprising. What are your thoughts about the market?
Yeah, that's what I have been looking at, more specifically a reversion from the NASDAQ comp rally actually started in late April. And of course, the NASDAQ 100 or triple Qs, their accelerating rally really got pretty steep starting in the latter part of May. That was one of the reasons I thought we would get a pullback, and more so with the NASDAQ composite and the NDX or triple Qs. We call up the first chart. Chart is the triple Qs. You can see on the top panel, 14-day RSI reached 79 just recently, the recent high. That's pretty overbought. NASDAQ, of course, the Qs get more overbought than the S&P 500, but we get near 80, pretty overbought. And we stopped during the rally right at a 78.6% retracement, which is the biggest retracement of any of the indices. And the NDX here and the Qs have been leading. Yesterday, all 3 of the major indices pulled back and dropped below their 10-day exponential moving average. Thought this would at least open the door for a challenge of the 21-day EMA, and it's still possible. A little caught by surprise by the amount of strength we're seeing today. But I think the 21-day will be the key here. It's very possible, looking at the Elliott wave counts, we've got one more pop to the upside, and then we'll see a larger pullback. But I think it's coming, whether from here or from higher levels. If we go to the next chart, it's the breadth of the NDX. It shows the percentage of stocks in the NDX or NASDAQ 100 that are above their 200-day moving average. Back when we were ripping higher, 2020, 2021, we basically stayed in the 70 to 90% plus range. Once the NASDAQ 100, or actually before the NASDAQ 100 peaked, we started to see some deterioration. And then from, early 2022 into the summer months of 2022, the percentage of stocks above their 200-day just collapsed. It was just a massive chart destruction, breadth wipeout, down near 5%. Stocks were trading above their 200-day. Had a big rally. That's sort of when the repair process to these stock charts began. Had a retest down in October, put in a higher low. And then since October, late September, October, we've had a very nice repair in many of the stocks. In fact, 75% of the triple Qs are now back above their 200-day. So I think that's a very good sign, even though I think we have gotten a little overheated here in the short term. Moving to chart number 3 is the NASDAQ. We retraced 61.8% of the bear market and then pulled back. We dropped below the 10-day EMA yesterday. We're back above. We stopped right at the 21-day EMA yesterday. So either we have one more run here or we turn quickly and then fade. And I would look for pull back maybe to the 50-day moving average or back to the breakout area down in the 12,500, 13,000 area. On the top panel, this is the Qs versus the relative strength versus the NASDAQ, and you can see the consistent outperformance by the Qs since going back to November of last year. This isn't the Qs versus the S&P. This is the Qs versus the NASDAQ. So you can see how strong the NASDAQ 100 has been, and of course we all know they've been led by maybe 10 stocks or so. If we move to chart number 4, this is a daily chart of the S&P 500, which also started to get a little steep here once we broke above the 4,200 area, which was prior chart resistance, prior top here from February. We had what was called a bearish overthrow, where we broke out above the top of the channel. That's typically bearish, at least in the short term. As you can see, yesterday we got down near the 21-day EMA, and we're having fairly strong day today. Just like the NDX and the NASDAQ, maybe we have one more shot to the upside, and then we get the larger pullback. A logical spot for a pullback would be the 50-day moving average, as well as the breakout level down near the 4,200 area. Moving to chart number 6, we have the S&P 500 in the middle panel, showing you the percentage of stocks in the S&P 500 above their 50 and 200-day moving average. I threw the OEX on here, which is the S&P 100, basically mostly mega cap stock and much less diversified than the S&P 500, higher weightings. And you can see on the top panel, we've basically been trading between 40% and 80% for the percentage of stocks in the OEX S&P 100 above their 200-day moving average. So that's, kind of in the neutral to slightly bullish area. A 50 obviously would be right in the middle. Currently we're at 63%. I wouldn't call that bullish. It's certainly not bearish, but it certainly needs to get above 70-75%. I think for a sustained bull market run here. That's what we've seen historically. And if we go to the middle panel, you can see that we've solid red lines, percentage of stocks in the S&P 500 above their 200-day. We're about 62% today. Certainly, just slightly above neutral as far as breadth strength is concerned. And we would also like to see this get above 70-75%. And then stay there. Moving on to the 6th chart, we have another concern here, another reason I was looking for a pullback, deeper pullback than we've seen so far. The top panel is the 5-day moving average of the CBOE equity-only put-call ratios. And you can see put the vertical red lines on. The last 2 times, August of last year and February of this year, once we got below the 0.60 area, which we are now in, we're getting close to 0.5 actually for the 5-day. But those last 2 times turned out to be intermediate term highs, and especially after that August 2022 occurrence, we had a pretty good pullback. Now, if we are in fact in a new bull market, the range of this 5-day and all other equity put calls will find another range that's lower than we've been in. During the bear market, we've kind of been trapped between 0.6 and 0.8. We did fly higher there at the end of 2022, but I think, in the new bull market, we will find, we don't know what it is yet, but we will find another more consistent range that's lower than we've been at. Moving to chart number 7, we have the downsloping 10-year Treasury continued downsloping channel. We're getting close to the top of the channel, which is up E7 if we look out a week or so. So it'll be interesting to see if we can bust out here. Good news is I think a breakout with yields shows that the investors, I guess, are worried about a stronger economy. If we break down and start heading back lower, then people are more worried about the economy. Another interesting thing about Treasury yields is that if you look at the daily, this is the top panel here, the daily and the weekly Bollinger bandwidth has moved to a very narrow level we haven't seen in quite some time. Generally, when the Bollinger bandwidths get very, very low, compressed, a big move is coming, so that's something to keep in the back of your mind. So that I would be expecting. I don't know what direction we're going to do. We've been in this channel here going back to October of 2022, but the consolidation, the tight range of bond prices here generally lead to a big move one way or the other. And looking at the chart number 8, this is a chart of the SLV iShares Silver Trust. Been in a pretty good correction. A couple of days ago, we hit a very important support area around the 2050 level. That coincided with the rising 200-day moving average, as well as a 61.8% retracement of the rally coming off the March lows. I'm not sure if you can classify this as a 5-wave down. It certainly doesn't look like an ABC down yet. You would think that if the first pullback here was A, and then you had B, you'd think C would be much larger. But we'll see. Obviously still in a downtrend. On the top panel is just the U.S. dollar, and you can see going back to the end of last year, back to October, November, that the dollar's kind of been stuck here between just above the 100 level and up near 106. So the next big move, I think, in the precious metals will be determined, which way the dollar goes. I will say that the COT data for silver, which was extremely bullish last year, is not in silver's favor right now. So that leads me to believe that we have either more downside or more sideways chop here for silver.
Mark, anything else you'd like to add?
Yeah, I have two Bitcoin charts. The first Bitcoin is a daily. We traced out a head and shoulders. Thought we'd get to 24,000, 23 to 25,000. That's where we got to. We were in this channel here for many months, rallied sharply since that low in mid-June, and we're back up near the prior highs, near the 30,006, 30,007 level. It looks like, on the daily chart here, we're tracing out a bull flag in anticipation, which is a continuation pattern, and that would suggest, if it is a bull flag, that the next move for Bitcoin would be another move to the upside. And chart number 10 is a weekly chart of Bitcoin, shows the whole last bear market, which was nasty, from the 60, almost 70,000 down to 16,000. Interestingly, as I've pointed out many times, I have a vertical green dotted line and a vertical red dotted line. They are associated. The first one, the green line, is associated with the U.S. dollar's breakout, which occurred back in November of 2021. That represented, was very close to the peak in Bitcoin. And then if we look at the dotted red line, that represents the top of the rally for the U.S. dollar. And it took a number of weeks, but, that corresponded very closely with the bottom in Bitcoin. The second panel shows the correlation 30-week basis between the Bitcoin and US dollar. And when we have big moves in Bitcoin, they're usually associated with the opposite in big moves in the dollar. On a chart basis, we're right up here against chart resistance and get very close to the 100-day moving average. Breakout, we've already broken out of an inverse head and shoulders here bottom. That would coincide with a measured move to perhaps the 32,000 level, which we basically already got to. First, I think key level here will be up near 36,000. That was from the bottom back in early 2022, so there's chart resistance in there. That also represents a 38.2% retracement of the entire bear market. But right now, it certainly looks like Bitcoin and Ethereum are setting up to have another big run to the upside.
Mark, thank you. Have a great day.
Thank you, Ed.